Welcome to another episode of Coffee with Alissa. Today, I'll be interviewing Heather Schreiber, owner of HLS Retirement Consulting. It's a company that provides education, training, and support from experts in retirement, tax, estate, and Social Security planning. So, Heather and I will be focusing today on Social Security. She speaks frequently around the country about this topic. I actually met her at the Financial Planning Association conference in Columbus, Ohio this year, and thought she brought such excellent insight and clarity to the Social Security world. So I wanted to interview her further and share it with you. How are you today, Heather?
I'm great. How are you, Alyssa?
Good. Well, first question, when is someone eligible to start receiving Social Security benefits, and how does your age affect the amount that you receive?
Most people, I think, know the answer to that question, although several studies show that that's probably one of the basic questions. And beyond that, consumers don't know, which is why financial advisors really need to be educated on this topic to help them. But the earliest age for retirement benefits is 62. And of course, the latest age that someone should ever file for benefits is 70. I hear people say all the time, more than I'd like to hear, I haven't even filed yet and I'm beyond 70. I'm continuing to work. Don't do that. So the ages are 62. Don't go beyond 70. You don't get brownie points if you wait beyond 70. You're just giving back money to the trust funds, which they desperately need, but you shouldn't wait. And so, of course, the timing of that will dictate how much you receive, right? So if you file at 62, the idea is you're taking it early. The benchmark really is to wait until you get to what's called your full retirement age or your normal retirement age. They mean the same thing. And that is when you get 100% of what's called your primary insurance amount. That is the amount that's based upon all of your years of earning. It's capped at your highest 35 years, which, we could talk for hours. This is a subject I love, but you kind of would, your goal should be hopefully to get to at least that point, because then you're not getting a reduction. If you take it at 62, which you can certainly do if you're not working and earning too much, then you're looking at getting it, up to a 30% reduction on retirement benefits if your full retirement age is 67, which is those born at 1960 or later. So, it's a big decision because, the idea is if you take it that early, Social Security says, well, you're going to get it, for essentially 5 years longer instead of taking it 5 years later at your full retirement age. So for that reason, we're going to impose a reduction. So, it's really one of those sources of income, and for many it is often their only source of income that is a lifetime inflation adjusted income. So it's a very important decision as to whether the timing of that is incredibly important. So that's a very long-winded answer to a very simple question.
No, it's good. It's a perfect transition to my next question, which is, when people are determining when to start Social Security benefits, what factors should they take into consideration?
Well, what you shouldn't do is say, well, I talked to Fred down the street, because what I always say is there's no one size fits all approach. And I hear people say, well, everyone should, if you're talking to, an advisor, a tax person, whoever, if they say, just take it at X without asking you a lot of questions, that is a bad idea, because everyone's situation is unique. You have to, of course, look at longevity, right? If you're looking at, how long do I expect to live? What's my own health? But you also have to look at, particularly if you're married, you have to look at the longevity of the two of you combined. Okay, you can't just look at your own health if you're married, and certainly not if you're in a situation where you have either a wide disparity in your income benefits, so one of you has worked and perhaps earned more than the other, or even age. If there's a difference in the age between the two of you, and maybe the younger one has a lower income benefit, or maybe it's the younger one has a higher benefit, that's going to dictate how we should look at when you should claim. You should also look at, when do you plan to retire? And you don't always want to say, okay, I retire, therefore I'm going to claim. That isn't always the right choice, and that's usually what we think. Well, I'm going to use this to replace income. Then you need to look at, well, is this the best replacement source right away? Or do we look at what other sources of funds do we have earmarked for retirement? Is this the best choice to use Social Security now? Or do we look at perhaps bridging income with another source to allow Social Security to delay? Because remember, it's that source of lifetime income that lasts, that is inflation adjusted in most years. We've only had three that have had no inflation adjustment. And so we have to really look at all of those things, and look at what our goals are. I mean, even if you say to me, legacy planning is really important. So I want to preserve this asset to give to my kids. That all comes into play. So it really is not something that you can look at in a bubble and say, well, I was told that, I should file here, I should file as soon as I can because it won't be there. Don't let fear be a reason that you also file either. You really have to work with someone who can really help you integrate that claiming decision into your particular situation.
In the first question that you answered, you mentioned one of your favorite topics, kind of how Social Security benefits are calculated based on your income over the years. So could you talk a little bit more about how the benefits are calculated?
Yeah, absolutely. And this is one of the things when consumers, a recent AARP survey looked at, asked consumers, and a lot of them failed these questions. They don't understand. And admittedly, it's a complex formula, but, a lot of the basic questions, how do you maximize benefits? What is your benefit based upon? They really didn't know the answers to this, and it's important to know. So at the very basis, to be entitled in the future to a retirement benefit, you have to have, on average, 10 years of Social Security taxable earnings, okay? You have to have 40 credits or quarters of coverage. And so you can earn a maximum of 4 credits per year. In 2025, I think it's $1,810 equals 1 credit. And so if you earn 1810 times 4, I'm not good at math at this very moment when I'm put on the spot, but if you earn that in a year, then you've earned your 4 credits. That's how you get that 10 years, right? Once you've earned that 40 credits, you can stop counting. And then at some point in the future, you have earned a Social Security benefit, but you don't want to stop at the 10 years. That will get you a retirement benefit because your benefit is based upon your highest 35 years of earnings, of Social Security taxed earnings, indexed to inflation. And what that means is those earnings that you had earlier in your career are sort of pulled up into current wages, right? So they look at all of those, and in the year that you turn 60, they index all of those earnings so that they look like the current wages in today's world, right? And that's what your benefit is based upon. And so the reason it's important to know that is that if you're someone like me, I took some time off during my career to raise some little children. And so I had some breaks. Or right now I'm dealing with aging parents. I'm still working, but I know that those, even if, say I have 25 years, I mean, I'm closing the gap now, but if I have 25 years of earnings in that calculation, Social Security just doesn't say, well, we'll just use the 25 you have. No, they still include 10 zeros in my primary insurance amount calculation. What does that mean for me? That means that my benefit, when it's computed, is going to be lower than if I can substitute or add in additional years of earnings. So that's what you need to be focusing on, is that if you are someone who has had breaks in service, or you have sort of that roller coaster earnings history, that you've been out of the workforce and gone back in, don't think that even part-time earnings isn't going to positively impact your benefit, because it can. The other thing that people often ask is, well, once I've filed for benefits, say I've filed for benefits and I only had 20 years of work history or whatever, it doesn't help me to continue to work even beyond that. It absolutely can. Your benefit is recalculated every single time you report earnings, even if you're already collecting. Social Security says, oh, we've received information that you did earn more money, so we're going to recalculate your primary insurance amount to see if this most recent year of earnings boosts your primary insurance amount formula. If it does, they will send a letter and say, hey, your benefit increased, not just from the cost of living adjustment that was declared in December, but because your most recent year of earnings boosted your benefit. And so they will pay that new increase. So very important to understand that it's not just the 10 years. The 10 years will get you in the door for eligibility in the future, but you want to try to get the full 35 years so that you have the highest benefit that you can possibly have and no zeros.
Well, shifting gears a little bit, can you explain the difference between Social Security benefits and disability benefits?
Well, Social Security benefits, I mean, there's a lot of benefits and people don't think about this. I mean, it's like, it is insurance, right? So you've got the base benefit that people think about is obviously having a retirement benefit. But think about those folks that never worked outside the home. They're still entitled, if they're married to someone that has benefits, are entitled to spousal benefits. Then we have even ex-spousal benefits in some cases for people that were married for at least 10 years. Then we have survivor's benefits. We have caregiver benefits for young spouses of people that have, say retired or died and are caring for children. And then we have disability benefits. There's a lot of benefits under the system that we pay for, right? That we put in from our paychecks. Disability benefits are there for someone who is fully disabled. Now, it isn't just, it's not like a work disability. It is, a strict definition of disability, the inability to engage in any substantially gainful activity for a period of at least 12 months or indefinitely that may result in death. I mean, it's the strict definition that the IRS uses, the same definition that you would use for exemption from the 10% penalty from IRA and qualified plans, same definition. And what essentially happens is that if you qualify, which incidentally, it's difficult to qualify. You can apply online for that, and you have to have your ducks in a row and get doctors. But what happens is if you get approval, a Social Security award for disability, then say you're 50-50 when that happens. Social Security gives you what's the equivalent of your primary insurance amount. Remember I said that's what you would get at full retirement age. They give you that at that point based upon your earnings to that point. So the benefit of it is you're getting basically an unreduced primary insurance amount at the point at which you're disabled. Now, it does require a recency of work test and a duration of work test. So you generally have to have, the same amount of work if you're old enough, older. If you get disabled younger, then there's less of a work requirement. You don't have to have all 40 quarters, but you definitely have to have a recency of work test. In other words, you couldn't say, well, I haven't worked in the last 10 years and now I want to file for disability. There's a recency of work test, but it is a good program. Some people say, well, should I file for disability now or should I take retirement benefits? Say they're turning 62. Well, if they can get a disability award, they wouldn't get a reduced benefit at 62, right? They would get their full retirement age benefit. So there might be some benefit of getting, applying for disability. So I don't know if that answers your question, but getting a disability right now, it's a pretty long wait to get the initial determination. They're trying to work on that. But yeah, the real big thing is having all the documentation in order before you try to apply. That's the big thing.
And you mentioned spousal and survivor benefits as part of Social Security benefits. Could you talk a little bit more about those?
So those are, so a lot of misinformation. Again, these surveys, I'm really into what do consumers know. One of the AARP results was that hardly anyone surveyed knew that about spousal benefits or how they worked. The real big change, and believe it or not, the Bipartisan Budget Act of 2015. This is what the act that kind of slipped through the door as part of the budget that took away these strategies, these claiming strategies that were really ideal for couples, for married couples, that allowed them to sort of leverage benefit strategies. One was called file and suspend, and one was called restricted application. Those went away. They're officially both gone now. And so people are still confused though. Like, when can I get a spousal benefit? When can I not? The thing with spousal benefits is that if there is a dependent spouse, and when I say dependent, I mean someone who either never worked and never got their 40 credits, okay? Or someone who has worked, but perhaps has a very small benefit. Those folks will get a spousal benefit. If their benefit or their lack of benefit for not being entitled to their own, they'll always get a spousal benefit, okay? If that benefit produces a higher, benefit than their own, okay? They're gonna get one. But the critical ingredient now is, in order to get a spousal benefit, their spouse has to file. That's the difference. So the higher earning spouse has to file in order for them to get a benefit. That's the big confusion point, and my practice of talking to advisors across the country. They're like, wait a minute, when do they get the benefit? When do they not? So spousal benefits are still alive and well. A lot of people thought that when all these two strategies went away, that nobody got spousal benefits. So I always differentiate between living spousal benefits and survivor benefits because they work differently. So they're still there. Divorce spousal benefits are still around for certain folks. I mean, you have to have been married for 10 years. If you have your own benefit, that benefit can't be higher than what you could get under the ex-spouse's benefit. So there's still things, and this is why, retirees or near retirees really need to partner with financial advisors who understand these rules, because you don't want to miss benefits that are available to you. And speaking of that, survivor benefits, I hear of the most cases where when they consult with Social Security and expect to get sage advice from them, first of all, Social Security representatives are forbidden from giving advice. It's in their program operations manual system, which is like the holy grail of their rule book. Okay, they can't do that. But there's also a lot of misinformation coming out of there because there's a lot of new people. There's a lot of turnover there, and a lot of their old folk, their seasoned employees have since retired since COVID. But survivor benefits is one of those areas where, with the right help, widows and widowers can leverage their own retirement benefits with survivor benefits. And what I mean by that, they can take one benefit first and take the other one later to leverage cash flow. It's incredibly important, and a lot of people miss it because they don't work with someone who understands they can do that. So incredibly important to really know your options before you go to make a claim. And the other thing is, I said earlier with respect to what factors need to go into make the timing of your claim. When you're, a couple, this whole, what's my break even? And, I think I'm, how long do I have to live for it to make sense for me to wait? Because everyone's like, I want it now kind of thing. What if I don't live long enough? With married couples, the critical ingredient with respect to survivor income, and most spouses are concerned about their spouse's income if they die before them, is that what I'll say is usually if I'm working on a case with, my clients are financial advisors, but I always look at the higher earning spouse in that case. Why I do that is because I'm not only thinking about lifetime cash flow, I'm looking at protecting the income of the surviving spouse. It's usually the female. And usually the female is the one that is hard pressed, that has less assets generally because of all the things that women have been challenged with career breaks and so forth. Because what that higher earning spouse has done in terms of the timing of their claim is going to impact what that survivor's income is. Because if that surviving spouse or the higher earning spouse filed early, say at 62, 63, that's the basis on which the survivor's income is that's what they're going to inherit. Versus if they waited, say till 70, they're going to inherit that higher or the lower earning spouse who out survives the other one. That's what they're going to inherit. So you really have to make sure that you're making the right decisions, not only for cash flow during both of their lifetimes, but also for the survivor. So it's incredibly important to really look at not only while they're both living, but look beyond that and try to plan for the survivor as well.
And along those lines, are there any other common misconceptions or mistakes that you see that are made, very frequently with Social Security that our viewers could benefit from knowing?
Yeah. So one of the big things that I see is people who take benefits or claim benefits while they're working. I generally say don't do that for a couple of reasons. One, the most obvious one is if you are continuing to work and you're under full retirement age, there is a limit that Social Security imposes called the annual earnings limit or annual earnings test. So if you are under full retirement age the whole year, let's use 2025 numbers since we're almost there. If you earn more than $23,400, now again, this is 2025. If you're over that limit, then Social Security is going to withhold 50% of that excess amount. So if you're over that limit by, say, $10,000, they're going to withhold 50% of that, or $5,000, from your benefits before they pay you. And so say you have a $2,000 a month benefit, well, they're going to withhold, that's 2.5 months. They're going to round it to 3 months. They're not going to pay you until month 4. So if you're trying to obviously are claiming benefits to somehow make ends meet or to supplement income, it hardly works from an income planning standpoint. So I'd say, be aware of that. A lot of times what I see is people say, oh, I'm going to go ahead and retire. I'm 63. I'm going to go ahead and retire. I'm going to claim Social Security. And then they say it's either not for me or I got some other job. I didn't tell my financial advisor or didn't tell anybody. I went ahead and took this job. And now I've gotten the Dear John letter from Social Security a year later saying, hi, you earned way too much and now we want our money back, because they find you and they sent you an overpayments letter. So you don't want that to happen either, okay? Because they will want the money back. So that's the biggest thing that I see. So I always say, if you can avoid taking benefits while you're working, and even if, like, somebody will say, well, I'm not working, but my spouse is making $100,000 a year, I'd still say, do we really want to take it? Can we find another source? Because even if they're not working and they can pass the annual earnings test, because the earnings of a spouse, when you want to take an early claim, is fine. You're only looking at the earnings of the actual early claimant. And you're not also the earnings limit also doesn't consider pension income, IRA distributions. It's truly earned income. But if your spouse is making $100,000, then you're already going to be taxed on probably 85% of those benefits. So I'm like, okay, let's think about this. We're going to take a reduction to our Social Security benefits already because we're taking it early, and then you're going to pay taxes on 85% of it. Do we really want to do that? This is where the conversation comes in. Can we bridge income with another source until both spouses? We've got one that's already retired, but the other one isn't making $100,000. Because again, we're always looking at trying to build a foundation of income that's that guaranteed lifetime income, an inflationary hedge. We try to really want to boost that foundation as much as we can by delaying it and creating sort of that pillar, that foundational pillar.
Heather, thank you so much for joining me today and sharing your vast knowledge of Social Security. I know there are tons of other topics within this field that we could discuss, but I think you provided a really great overview and information for our viewers. And so to our viewers, thank you for watching. We'll see you next month.